Hi there, everybody. Great to see everybody coming in. Fantastic to see so many of you coming from so many different places all around the world too. I see some from Spain, Bill, some from America, Bruce. Thanks for tuning in from over there. And lots from the UK. I think it's great how everyone mentions where they are. It's lovely to see how far apart we all are, and also all of us descending on this event today. There's still more people coming in, so I'll just just chat generally. This webinar is really oriented around the stock reports, and it will sort of summarize some of the kind of forensic stock analysis that you can do using the stock reports, and hopefully you'll learn quite a bit about how to get the most out of them. There's quite an extensive set of slides here, and it's going to be quite good fun. Brilliant. We've got someone from Norway. I love Norway. I've been to Oslo a couple of times. Kjetil, I think your name is. And we've got Patrick from Oxford. I'm in Oxford at the moment. Our office is here. And although we're almost fully remote now, but we have our den here. Okay, I think I'm probably going to crack on because there's lots to get through, and I know everyone will get hungry, so I'm going to crack on. Right. So today, forensic stock analysis. First up, I'm Ed Pagecroft. I'm the founder or co-founder and CEO at StockReports.com. My background's in wealth management in the city, and I have been investing in markets since I was a student, and I love doing what I do. And this was really a hobby project that got out of control. And now I'm just so humbled by how many people are using what we have, the community we built on the site, and all of you subscribers who are on today. It's really fantastic to see so many faces, and hopefully you've been gaining from this rally we're seeing in the markets. It's been a really brutal. Last year was particularly brutal for all of us, and markets do go down as well as up. It's a horrible thing, but that's equities, and it's that volatility which keeps so many people away. And ideally, well, really is one of the reasons why there is an equity premium over time, because nobody likes losing money. And because the market tends to go down once every 2.5, 3 years, depending on where you are in the world, that does create some of the conditions for better returns. So although it's down markets, I hope that in the coming months and years, we'll get good results from the market. So is this forensic analysis or stock report webinar for you? I know you're all, or most of you are subscribers, and so I'm sure you're very familiar with the stock reports. But I really think there's kind of two sort of types who can get a lot out of this. Seasoned investors. I know a lot of really great investors who do all their own research and all their own spreadsheets, but one of their first port of calls is the stock reports, because it really saves time and effort early in that share research process for whether you want to go and dig deeper. But also, if you're an improving investor, it really does help. It's a fantastic educational device, but also provides a lot of discipline for sanity checking stock ideas. And and if you're an international investor, we've got stock reports obviously all around the world, and our home is in the UK, where the majority of subscribers are, but there are benefits to all of you. Now, before we get started, nothing in this is investment advice. We are not an investment advisor. Stocks go down as well as up. I've got to do the duty on the disclaimer. And any past performance here is not a guide to future performance. And please do understand this is for educational, informational purposes. And if you're uncertain on anything, please get a financial advisor. It's very, very important to say that. So on to today's agenda, I want to quickly, by the way, one thing, I believe in our webinar tool, you might need to turn on the audio. Sometimes people say they can't hear, and there is an audio setting. So I just wanted to remind you of that. So I'll quickly whiz through how the stock reports help you save time and improve results, because there's a bit of a legacy of stock reports from other services that have really been inspirational for what we do. I'm going to sort of give a lightning tour of 7 key areas to understand on the stock reports. And then I'll have a little brief diversion into some of the hidden features on the stock reports that are worth knowing about. And then I thought I'd analyze 3 shares, a growth share, an income share, and a value share, which kind of allows you to sort of look at a stock report in a slightly different way and from a different lens. And then there'll be time for Q&A afterwards. So let's crack on. Firstly, the power of simplicity or essentialism. This is something which, when I got started in investing, I just loved single page reports. And in America, there's a fantastic, the big daddy of single page reports is Value Line, that has a digital tool, and Warren Buffett used it. And it's got a very long legacy, but I think back to the 20s. And in the UK, it was Jim Slater who set up company Refs, which was one of the first products I used when I started in investing. And I read all his books, the Zulu Principle I got behind me, and a range of others. And we actually ended up acquiring company Refs when it went into administration with Slater Investments. So a lot of we are kind of standing on the shoulder of giants with what we've put together. And I think why the one-page format matters is quite simple. You've got space constraints, and that's a forcing function which ensures information density, a high signal to noise ratio, but also it sort of encourages the creation of, we have our proprietary data based on algorithms, which can be huge time-saving devices and give even more insights than just looking at the raw data, because not everyone wants to learn to be an accountant. And while I've done all the CFA exams and everything, I love using more algorithmic and ranking data to make my own decisions. And that allows you to make faster, more confident initial share assessments. But of course, don't rely on everything you see on a page, DYOR, we say in the UK, do your own research. And so what we've done with the Stockopedia stock reports, as I'm sure you know, it's like this print ethic, but it's brought online. It's definitely more than one page, but it's a bit longer than a one-page print, prints out on two. But it's all the essential for statistics, really comprehensive, clear design, interactive, color-coded forensic analysis in seconds. So I'm going to be diving through a bunch of areas on the stock report, and I'm going to go into some detail. Now, where does the data come from? Because this comes up quite a lot. We get asked, how often does it update? Where does it come from? And I think this is worth spending a moment on. So first up, our primary data sources for raw data. The primary source is Refinitiv, which was spun out of Thomson Reuters, and they employ hundreds of analysts who scan, audit, standardized financial data entry into the databases and upload it to their clouds. We also have some other smaller data vendors like Smart Insider for our directors' dealings data, where we try and up the quality by really adding on different databases. We also got all the stock exchange data that comes down from all the stock exchanges, and also index providers like FTSE, etc. And what we do is every night we import that data. We actually do it multiple times a day onto our Amazon Web Services, into the cloud. It's an amazing service. And we download financial statements, analyst forecasts, price quotes, shareholder data, directors' deals, profile information, all of that. Now, that comes in as raw data, which we then compute using our analysts and our developers work together to sort of compute, tidy, organize, structure all this data. And then we crunch about 60 million computations daily, which brings up our sort of library of 2,000 ratios on every stock, which then, from the P ratio to more advanced measures. And then that gets published on Stockopedia, where we publish all the ranks, the screens, and all the kind of nice, interactive, beautiful stuff you see on the site. So that is quite a big process. Now, it doesn't stop there. There is a feedback loop, which is quality control. And interestingly, when we set up Stockopedia, we became it was Thomson Reuters back then, one of the top feedback sort of data issue creator in Refinitiv support in the entire world, even more than Goldman Sachs and all the big banks and Merrill Lynch and everything else. And partly it's because we were one of the first retail investor websites to use this, and we just started getting all these subscribers and all of you. And so we really take data quality very seriously. And this is not, I've got a really fantastic team, and including myself and Ollie, who's head of product. And I'm sure if you ask a support query, you're going to talk to some of these characters. Alex Namani, and who is really the kind of guru of all of our Refinitiv data and as a sort of technical data manager. And Dan Smith in his shades there, who you might remember as Holland Smith on the small cap report. We hired in Dan from the community, and he does a fantastic role on the product. And Keelan, who's been working with us for many years now as an intern and then now as a full-time employee, who's also got a finance degree. So there's all of that, plus the editorial team, the engineering team, and all of our subscribers who give and create that feedback loop, of ensuring we get very high data quality. So I kind of see that the database that we have is as much impacted by everybody here on this webinar and in the community in improving the quality on an ongoing basis. And I'm really, I think I can't underestimate the impact that everybody has, because our eyes can't be everywhere, even though we've got scripts and algorithms everywhere trying to sort of make sure everything is as accurate as possible. So thank you very much for everything that you've done in helping us improve over the years. Now, the 7 key areas I'm going to focus on. Okay, I'm going to be using Jet2 as my kind of key example. Now, this is a UK company, and it's been a huge winner over the years, previously as Dark Group, which many of our subscribers from the very launch of the site back in when we first opened to subscribers in 2012, this is one of the sort of top ranked shares, and it's been a big historic winner. 3 times a constituent of the NAPS portfolio that I publish on the site. Twice it was a 1-bagger in a year for that. But the pandemic was very tough for airlines and travel firms, and Jet2 had to do some rights issues. It's now in recovery, and it's recently had a large jump in the stock rank. I'm not a holder. Jet2 I'm using this for illustration purposes only. It's not a recommendation to buy. I'm sure you understand that. Do your own research. It's just good for illustrating a lot of these features. So what I'm going to be looking at in a bit more depth is the stock ranks, quality, value, and momentum factors, which drive stock returns, the classifications, which are really valuable for understanding the category of share you're dealing with. And there's a lot in there. Don't overlook it. The traffic light system that we have on the site, which allows really fast peer comparison. We're also going to look at the what I call the professor scores, or the red flags, which are very useful sort of time-saving algorithms from the academic world, which will go into some detail. And also this little widget on the screening rules that a stock might pass, which is quite handy because it sort of lets you understand if you can go and look at the screen or the checklist and see and understand those rules. And it's quite a good education in a whole range of things. Also, I'm going to go in depth into the financial summary, which stems right down the page, and how to read that. And I'm also going to look at some of the shareholder activity metrics that we've got, because this is really valuable data, and we've been improving it over the last couple of years. And, to sort of help understand the prediction of travel, what the major owners and big forces in the market might be up to. So that's kind of the idea. Now, the trick here, as Peter Lynch said, is not to learn to trust your feelings in stocks, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. And if you haven't read One Up on Wall Street, it really is an investment classic, should be on everyone's library. It's a brilliant read. He was a great writer. But he believed in the fundamentals. He also believed in the narrative behind the company too. But a very fundamentally driven investor, and a real inspiration to what we do. Now, obviously, all we do on the stock reports, it's all about the fundamental data. So everything I'm going to be focused on is the fundamentals and the technicals and what that means. So hopefully that will be of some use. Okay, so I'm going to go a bit deeper into each of these sections now. This webinar, I've got lots of slides. I'm hoping I can get it in an hour plus Q&A, but I've got these 3 demos afterwards on a few shares I'm going to sort of show you how to analyze. So that'll be quite fun. Okay, first up. Now, I'm sure many of you are very, very familiar with the stock ranks. There are these 4 numbers we have up in the top right corner. And they are simple measures to identify good, cheap, strong stocks, quality, value, momentum. And I've written a bit of an ebook on this. It's going to be published in a few months, and it will go into a lot more extensive detail then. We're coming up to the 10-year anniversary of the stock ranks, and they're very powerful measures. I was asked, can you go into some detail about the makeup of each of the ranks? Now, there is a lot of information in the Learn section on the site, so do check in there because you can find the actual metrics that go into it. And I will do a dedicated webinar on this in future. But in brief, the quality rank is based on a few key ideas. Firstly, is it a strong and stable business? We call this the franchise factor internally, and it analyzes long-term profitability of the return on capital, profitability, gross profitability, the cash generation over assets, and sort of stability and growth. So the operating margin stability and sales growth consistency. So it's kind of our Buffett-esque input into the quality rank. We also have a fairly high weighting to the F score. which I'll go into more detail in a minute. But that assesses the trend in the fundamentals from one year to the last, and which has been shown as quite a predictive measure of where the fundamentals are heading. So there is a sort of fundamental momentum measure in the quality rank, which is a key insight. The other thing is we actually decrement the ranking based on any kind of catastrophic risks, which is the red flags I'll be talking about in a mo. The risk of bankruptcy, the risk of earnings manipulation or cooking the books, as well as leverage risk, and which I think these are powerful factors on the quality of any company. So that's kind of in a nutshell the quality rank. The value rank measures the cheapness of the stock or the price of the stock against a range of fundamental metrics. So in a nutshell, is it cheap against what it earns in terms of its sales, its cash flow, and its earnings? We use the P, the price to cash flow, the price to earnings. We also look at whether it's cheap relative to what it owns in terms of its assets, in its price to book ratio, which is a kind of classic measure of value for more asset investors. And also, is it cheap relative to what it pays out in dividends in terms of the yield? And this actually gives us a way to look at all the companies in the market, even if they don't have earnings, if they don't have dividends, if they don't have assets. It creates a composite measure of value. And this idea really came from James O'Shaughnessy in the great What Works on Wall Street. I actually wondered if I had to dig that out of the shelf. But in his, I think, a 4th or 5th edition, he talks about a value composite. And this was inspired our value rank. And then next up, the momentum rank. Now, momentum is broken into two parts. Price momentum, which measures if the stock is strong relative to the market. And you can think about that as a share going up towards its 52-week highs, it going up, its moving averages rising and above its price, and so on. So that share price momentum and relative strength against the market is a really powerful factor. And then also we look at earnings momentum. So for any stock that has earnings, we actually put a 50-50 composite of earnings and price together. But if it's got earnings estimates from the brokers, in other words, if the brokers are forecasting profits, we actually make it 50-50. If it's missing that, it's pure price momentum. So that's worth being aware of. And we basically look at whether the company is beating its forecasts when it does results, when it issues results. We also look at whether it is there are earnings upgrades. I'll talk about this in a bit more detail later. And we also look at whether the recommendation is ratcheting up. I get some questions about, should we trust the analyst recommendations? And I'm going to be answering that question in a bit. So it's really useful to know. So the stock rank as a whole is a kind of composite of all three. And I'm going to answer one question that came up about this in a minute. But let me just first let you know, if you don't already know that these are all ranked as percentiles between 0 worst and 100 best for each measure. So 100 quality rank is kind of the top 1% of ranked shares for quality in the market. If it's got a rank of 23, it means in the bottom, it ranks only better than 23%. So it's in the bottom quartile. And one thing that often comes up, and this is Jet2 as of yesterday, I think, Jet2 stock rank is 96, which you can see is above the momentum rank, the value rank, and the quality rank. And I often get the question, this is weird. Why is the stock rank higher than the other ranks? And I want to express it's not an average of all three. It is the sum of all three re-ranked across the whole market as a percentage. And that's why it can be higher than those numbers. So in other words, the sum of these three is higher than 96% of the market. So that's a good thing to understand. Next up, underneath the share price chart there, you'll see this little chart, and that gives you the stock rank history over time. And we try and archive that daily so that actually you can track it against the share price. And you can see the sort of the shift in time. And you see Dark Group got in 2021 and all this pandemic time, the rank was just collapsing. And then it's just recently spiked up, which is quite interesting. We have colored that in bullish and bearish zones, but you can use that as you will. And I will do a proper webinar on this, but much like in all of O'Shaughnessy's work and all the quants that do the work, we've seen this trend in higher ranked shares that they tend to outperform and lower ranked shares tend to underperform. So that's kind of, obviously historic data, but the whole theory of factor investing is that you want to expose yourself to higher what they call factor exposure shares. So if you have a portfolio that is more weighted towards high quality, high value, high momentum shares, you have a better chance of outperforming the market on average over the long term. And it doesn't work every year all the time, but on average, it's like an actuarial, the stock market is kind of like an actuarial weighing machine that sort of tends to reward these kinds of shares on average. Now, we've also seen, this slide needs updated for the last 12 months, so it will have come down a bit. But we've also seen like a higher hit rate of picking winners in higher ranked shares, which are in blue here. So you see in the 90 to 100 ranked shares, we see a sort of percentage of winners on average, which is higher than the percentage of winners on average for low ranked shares. But interestingly, low ranked shares, somebody asked a question, said, why are the fund managers always mentioning their favorite idea and it's always got a low rank on Stockopedia? And one of the things is actually that even though you get in low ranked shares a higher percentage of losers, at the very extreme margin, you find that there are big winners in those buckets, but it doesn't overweigh the performance of all the rest. So it's a bit of a lottery. And sometimes fund managers are kind of incentivized to, through high watermarks on performance, that they want to basically find shares that are going to be quite high volatility and actually really, really rock it on a bull market. So that may be one reason. When to sell, this question comes, and how to use the stock ranks for timing. So I've shown this slide in a few webinars recently. And basically there was a great piece of research by Christoph Reschenhofer. And in this chart, you've got the buy rank from 50 to 95 on this axis, and the sell rank from 50 to 95 on this axis. And he in his research, used a very similar kind of ranking methodology as we use. So I thought it was kind of a good analogy to us on the site. And where this is green is a kind of a good buy sell trigger point. Where it's red is a bad buy sell trigger point. So, and you can see right here is that sweet spot. And he's got a few different charts, but I kind of summarize this as a 90-70 rule. In other words, and even before I found this research, that was my own intuition, was that buying at I like buying at 90 plus, and I would sell at 70. If you sell, and that's not, again, not advice, but it's something that I think practitioners that just use the stock ranks for their entry and exit, they found that kind of minimizes transaction costs, means they don't overtrade and so on. And it gives enough leg room for stocks to run. So that's quite a useful rule of thumb. And this is a case study of Reach PLC, which I did own in the pandemic, which spiked up to a rank of 90 in this little performance chart, 4 bagged. And I actually sold there at about, which was just after it dropped back below 70. It doesn't work every time, but that was a terrific bit of timing because the share fell considerably since then. Okay, on to classification. Remember, I've got 7 things I'm going to work through. So the classifications are here, right underneath the price quote on the stock reports. And these are really, really powerful. I got so excited when we launched these because they kind of sum up a share in a little sentence. Speculative large cap super stock, they're calling Jet 2 at the moment. And understanding this is quite important. Firstly, there's the sector, the risk rating, which is based on the share's volatility, and more volatile shares have a higher, more speculative risk rating. Large cap to small cap to micro cap, and also mid caps, as the size group, and the style, which is based on the stock ranks. And this is our own classification system, much inspired by Peter Lynch and his book, One Up or Wall Street. So sectors, I went through this in my NAPS webinar recently, so I'm not going to spend too much time here. I like to think of 3 super sectors, cyclicals, defensives, and sensitives, and defensive type shares held up beautifully in the pandemic and last year. Healthcare stocks, food stocks, so defensive consumer shares, and utilities. They tend to be they hold their value a lot better in down markets, but they don't rise as much often in bull markets. And although many healthcare stocks rocketed in the pandemic, obviously for obvious reasons. Now, cyclicals, consumer cyclicals, financials, mining stocks, that kind of thing, they're often can be quite cyclical with the market, and especially when there's recession fears. And we've seen a lot of consumer cyclicals and industrials. These are kind of the more sensitive sectors, not as cyclical as some of the others, but energy stocks, telecoms, technology. And of course, different market cycles have different behaviors. Last year, energy stocks did very well, while a lot of other cyclicals were sort of deteriorating. So These are really particularly useful for when you're diversifying your portfolio. And I said it in my NAPS webinar, and I'll be doing more kind of education on this, but I really do think it makes a lot of sense to have defensives and cyclicals and sensitives in a portfolio, because it just gives you more of an all-weather portfolio, unless you're good at timing the market cycle, in which case you can kind of pour into one or the other sector if you're right. The risk rating. So we've actually launched an ebook on this many years ago now, but you should read it. It's very short and it's really good to understand. This is a 5-level classification. It's based on the share price volatility, and highly speculative shares have had a tendency to underperform, except in the pandemic when they absolutely knocked it out of the park. Lower risk shares don't rise as fast in bull markets, but they don't fall as much in bears. And it's the tortoise and the hare approach, which actually leads to generally lower risk shares outperforming over the long term. So, and risk here is defined as upside and downside volatility. So you should bear that in mind. Jet 2, speculative, that's at the higher end of the volatility spectrum. So, not for, widows and orphans and all that, but it's a more speculative large cap stock. And as you can see, the share price has been pretty volatile over the kind of years. We use a 3-year look back to make this measure. So it's very powerful. And this needs updated. I haven't updated this for a few years. I really must. But this is essentially shows that highly speculative shares tended, in red here, have tended to underperform on an annualized basis, whereas conservative, balanced, adventurous shares have tended to do okay. Now, this is really interesting because we found that the best performing style of stock was speculative high flyers and also conservative super stocks. So I'll talk about the style in a minute. But it doesn't mean if you have a speculative stock, it can't be a complete market beater. There's a lot of speculative small caps that do very, very, very well. So this is just about averages. There's a lot of kind of junk on the smaller part of the market on AIM and so forth. Okay, next, the size group. Now, many small cap investors, I am sure, Alexander asking where the books are. Go into Learn, scroll to the bottom, you'll find a link to books. The large cap, size group is, I again think people don't diversify wisely across the different size groups. Now, a lot of people sort of hear that small cap value stocks outperform, so they put all their portfolio in small cap value, and then they find that in practice, the drawdowns can be very, very testing and very emotionally difficult to handle. I actually think it's quite good to have large caps in your portfolio, much like it is to have defensive shares. So this gives you another good quick fix on what the size of the share is. And you can think of it kind of like the FTSE 100 are large caps, the FTSE 250 are mid caps, FTSE small cap is small cap, etc. And that really, there are parallels with the ASX, if there's any Australians on here, ASX 50 mid cap and small cap. So it's kind of got a correlation with kind of indices that you might know. And one other thing on size, so we're still in the header of the stock report. One thing is that if you look at the market cap, which is the value of all the shares in the market summed up, okay, so price times the number of shares is the market cap. Everyone tends to focus on the market cap because that's what they think is the value of the company. But actually, the enterprise value is a very, very important measure of to understand the company, and that is that basically it adds the net debt to the market cap, and that's a very important thing to understand. If it's much higher than the market cap, the business normally has a lot of net debt, and a quick eyeball of that can give you a lot of understanding of debt. So let's move on. Stock rank style. One of my favorite things when coming up with this, and I'm sort of the architect of the stock rank system, so this is very close to my heart. This is a 9-level hierarchy based on a few combinations of the stock ranks. I'm not going to go into too much detail, but do read about it in the Learn section under the stock ranks link. So there are 4 what we call winning styles, which are super stocks, high flyers, turnarounds, contrarian. I'll explain that in a mo. There is about a third of the market unclassified, and 4 losing styles: value traps, momentum traps, falling stars, and what we call sucker stocks. Or probably a nice way of thinking about them is nothing but the story stock, which in other words, there's no kind of real great fundamentals behind it, and it's a real jam tomorrow kind of play. And you find a lot of potentially there might be great companies in the future, but they very much are jam tomorrow, blue sky kind of stocks. And a nice way to understand this, we have generally found, because these are higher ranking classifications, they've historically outperformed, whereas the losing styles have historically underperformed. On average, there's a huge dispersion in outcomes in individual shares, but that's a useful thing. Now, this grid, and by the way, we will send out the slides, so I will make sure that these resources are made more available, sort of educationally around the site and so forth. This kind of gives you a very nice little mnemonic. You can take a screenshot if you like. The winning stars, so the super stocks are basically this QVM, quality, value, momentum. It means they've got 3 high ranks. At the other end of the spectrum, the sucker stocks have got 3 low ranks. And then these other winning stars have got 2 out of 3 good ranks. So turnarounds tend to be cheap, but on the rise. High flyers are expensive, but high quality, good momentum. Contrarian shares are more Buffett-esque. They're really good companies, good quality. They're quite cheap. And then momentum tends, they sort of, they might have had a setback. And so, the rule of thumb I have in picking all shares, and I never, ever break this myself, except if I am having an edge punt, which I'm quite partial to, is to have 2 out of 3 of the ranks fairly high. That is what I always tend to do in my own investing. My own favorite style is turnaround investing and value and momentum. We'll talk about that later. And losing styles are things like value traps. So you can find a really, really cheap share, but if it's not backed up by profitability, and if the momentum is weak, that's a value trap. Falling star. I mean, I think somebody asked a question about big US stocks, such as, Amazon and Meta and stuff. And I think I was looking at Amazon, and it's classified as a falling star. So it's actually very high quality. It's got great gross profitability, but it's really expensive. So low value rank, and it's trending down. So low momentum rank. So you often find high flyers turn into falling stars and so on and so forth. So there was a great article by Mark Simpson on the site about surfing the style changes, which is worth a good read. So anyway, that's a quick overview of that. Third up, peer comparison, comparing the essential statistics of every stock against the peer group. So these widgets we have actually running down the stock report are really valuable. And by the way, I don't have enough time to go into deep financial ratio analysis in this webinar. We are going to ask a survey to say, would you like us to actually go and do education around financial ratios? Please let us know. I think Lawrence is going to send a survey on this, but I'm not going to go into all the ins and outs of all the ratios. I'll talk about a few, definitely. But the traffic lights are a way of eyeballing where each ratio, so most of you will probably know the PE ratio, the price to earnings ratio, and the dividend yield, and profit growth, earnings per share growth. Now, the P ratio here is 10.5, and that's ranked against its industry and the market as a whole. Okay, so this shows that P. Sorry, I haven't updated these numbers on the left, so excuse that they're not correlating with what's on the right here. But if it's cheap, you'll see a green bar here against its industry or the market. If it's kind of more average, it'd be amber. So you can see this share at 2 is sort of more amber against the market. And if it's expensive, it would be red and thin. And this kind of, the width of this shows you kind of where the ranking is. So the yield is very poor against the market, but the earnings growth is projected to be very strong. So, and they're all RAG rated, obviously. And the more full and green it is, kind of the better. But beware of things like really, really super cheap stocks that have full green meters, because they can have issues. And one other thing to know is that when you hover over these, you'll get a pop-up which shows you a bit more detail on the ranking. So that's quite useful to know. Now, these are the forecast ratios. I really want to help you understand how we compute forecast ratios, because this comes up, we get questions in support all the time. And I think it's what we've tried to do is something which we really inherited from Company Refs, which we acquired. And Jim Slater wrote about rolling ratios a lot. And we use what are called forecast rolling ratios. And this is something that is particularly useful for growth investors. And it's kind of an inheritance of Company Refs that we publish these rolling forecast data just at the top here. Every other traffic light is on historic data. But when you're comparing companies, it's really essential when you're using forecasts to be comparing them on the same like-for-like basis. So I'm going to explain this. There's a little bit of like maths here, so just bear with me. We're going on to numbers 4 to 7 in a minute. So if you imagine that, say the current data is about September this year, right? A bit in the future. And the company's share price is £3, 300p, or dollars, or, you can convert it if it's in America. And let's say you have a company which has a year end in December, in 3 months' time, and the earnings forecast is 20p. Okay, that would be a PE ratio of 15. And if you had company 2 with the same earnings forecast, same price, 20p, but it doesn't report till September next year, the P ratio would still be on most websites and out there. The forecast PE would be 15. So you've got the same PE ratio for 2 stocks on completely different reporting dates, 9 months apart. Crazy. So what we do is let's take company 1. And what we actually do is we project a rolling 1 year ahead date to the day. And then we add a quarter of this year's earnings and 3/4 of next year's earnings. And then basically we turn that into what's called a rolling earnings forecast. So because most of the 1 year forecast will be weighted by next year's earnings, we get 3/4 of 30p, quarter of 20p, which actually gives a 27.5 pence forecast profit per share for that stock, which means the real 1 year PE of that share is 10.9. So remember that other company reporting, company 2, on that date had a P ratio of 15. And it means that if you were just using normal forecast data, you'd be making a real gross error in the forecast, in the valuation. And this is a really, really helpful thing for growth investors. So I just wanted to sort of explain that. And I think that's an important aspect to know. Now, many value investors don't like using forecast data. In fact, many of you on this call might be going, oh, I hate you. I hate brokers' forecasts. Okay. So we do have key valuation ratios, again, with traffic lights, all based on what's called TTM data. I'm going to explain that a little bit later, trailing 12-month data. And we look at the price to book value, price to free cash flow, price to sales, and EV to EBITDA, because more private equity people like that kind of thing. And again, with all these measures. Now, if you don't understand the absolute number, you will be able to understand the traffic light. And that's really helpful. I would encourage people to learn about these, happy to do more education around them. There probably isn't time today. So, do dig into them. And if you click any of these ratio names, you get pop-up, gives you education, gives you some ideas for further reading and so forth. Okay, quality. Now, these are the key profitability ratios, and any company with sustainably high return on capital, return on equity, and operating margins may be a sign of a competitive advantage or a more Buffett-esque company. You'll want to look at the history too, which we'll come to in a minute, but there are some ways to think about this. Companies with high returns on capital, if they can borrow at a lower rate than their return on capital, they may be able to borrow and gear up a bit and drive more earnings per share growth. Great companies that reinvest their capital at this kind of rate of return. So scalable businesses with high returns on capital are really, really fantastic, can be fantastic businesses, but they do attract competition. So that's worth bearing in mind. And you find high return on capital, high return on equity across all different sectors. Now, one thing about operating margins to be aware of is that they tend to be more industry specific. And this is the operating profits that are made on revenue, on sales made by a company, and that creates the margin. And so if you look at, for example, a food retailer, they'll tend to be on low profit operating margins. It's a very low margin industry, but they have huge scale, so they get like high asset turnover. So don't be put out if the industry or market operating margin is low. It's worth looking at at it compared to, if it compare it to its peers. So look at the industry rank rather than the market rank. That is normally quite helpful. I just want to flag also some of the other ratios very, very quickly. Again, maybe a follow-up webinar would be best, but I always like to look at the gearing of a company. That is the amount of debt versus the equity. And I've always liked to look for companies that have a lower than 50% gearing ratio, as otherwise, especially in higher interest rate environments where companies might need to refinance their debt, there can be kind of issues. And interest cover is also worth looking at, which is how many times the interest payments on debt is kind of covered by profits. So worth kind of looking at these. I'm not going to go into stripping out intangibles and stuff. It's a bit advanced for this webinar, but also these are liquidity ratios. The current ratio is quite useful. And this is essentially like if the company had to liquidate for whatever reason, it is how much their kind of available current assets cover their liabilities, current liabilities. And when these kind of measures get below 1, they are the current and the quick ratio. It can be an indication of there could be issues. But look, it's a bit probably for another webinar. So red flags, number 4. You'll see here, just next to the financial summary, these 3 little meters. And I think these are really, really helpful. So, as I said, I'm a CFA and I like every shortcut I can to avoid going to the accounts. That might be blasphemy to really, proper investors. But I've always learned that, and I learned this from people like Ben Graham, that when you're using diversification in a portfolio, all you have is much higher confidence, but not necessarily better results when you actually dig massively into the data. So I've always liked algorithmic measures which actually investigate the accounts first, which then will, if there's a problem here flagged, I'll go and look in the accounts. And I think that's really important to understand. So we have a health trend measure, bankruptcy risk measure, and an earnings manipulation risk measure. So going one by one, the fundamental health trend, this is a 9-point checklist, and each of these roll up actually into our quality rank 2. And this was originally designed in 2002 by Joseph Piotrowski in a famous paper. And he used it to separate winners and losers in value shares. So if you are finding cheap shares, it's quite always good to look at the health trend here, the F score, because it actually defines you can have a very low quality company with a high F score. So in other words, something recovering from weak profitability, it will start actually seeing improvement in profitability, in paying down its debts, getting more liquidity, getting more efficient in its operations. And the F score really flags that. So it's a very valuable tool. It's sort of independent of current quality. It's more about the direction. Bankruptcy risk, this is Professor Edward Altman's Z score. And we don't publish this for financials because it's not relevant to them. But this is 5 business ratios go into this. And we generally sort of standardize this into a safe zone, a cautious zone, and a distress zone. I would say that some companies, and there are some unusual situations in the market where, and I know there's a controversial one about capital leases where they have been rolled into total debt by the accounting standards bodies. So sometimes you do see some companies with kind of nearer this distress zone, which aren't necessarily distressed. And that's something to be aware of. I always like to use diversification in my portfolio. I'm quite comfortable holding risky shares that may have sort of lower quality metrics because I'm often more of a value and momentum guy. And so I normally pay more attention to this, but everyone is each to their own. And if you're somebody who really needs capital safety, looking at the debt, looking at the bankruptcy risk, finding safe shares is absolutely imperative. And earnings manipulation risk, this is the M score by Mesod Benesh. And this uses a bunch of ratios to try and figure out if a company's kind of cooking the books. It correctly identified the Enron fraud. We've found it's flagged for many kind of UK companies ahead of accounting errors. Sometimes they have really honest mistakes. I remember Superdry, there was years ago, it had an issue and it sort of tanked in the day and the M score was flagged on that one. So it can be very useful. It often can flag on very high growth companies because they often come with high growth environments come with a lot of pressure to keep it going internally. And that can sometimes lead to, kind of creative accounting. So it's a very useful tool. Screen rules. Okay, number 5 of 7, by the way. And so screen rule qualification. I find this quite useful. It's right here on the StockReports. And you probably know if you go into browse, you'll find all these 65 different guru screens that we publish. And we tag all the stocks in the market that qualify for them. So we can see Jet2 is qualifying for one of those screens. And that's quite useful, actually, because you can then click through, view the screen. You can just get a sense of like, okay, it's in what he's calling his bargain screen, but it's more of a value and momentum screen. And you can then actually even look at the checklist. If you click through, you can actually see all the criteria that stock is screened against and why it's passing. And that's quite useful. So if you see, there are some stocks which got like 12 screens passed. We also have what's called a few short screens, which is a kind of a red flag. So if you see that it's qualifying for a short screen, it probably means that it's got something which needs further investigation. So that's worth checking out. 6 is the financial history. Now I'm going to go into a bit more depth here because this is quite a useful area of the reports. And you find these financial summaries on all those old classic print products I'm talking about. And I love this because it gives me a way to essentially analyze the last 6 years history and some forecast data at a glance across really, really key metrics. And it's just, it's just so valuable. So what we got here is 6 years essential statistics at a glance. So we've got the revenue figures, the operating profit, net profit, and all these profit figures here. There's also a indicator of what the measure unit is. So some of these, for example, for the UK, we've got things priced in pence per share. So there's a P there. If you're international, it will be something else like a dollar or cents. And these profitability measures are percentages. We've got cash flow measures, dividends. I'm going to talk about some of these different areas in a moment. So 10 years of financial statements are full accounts are a click away on the accounts tab, which you can then go and investigate further. We also, when a company has published quarterly or interim results, after the year ends, we publish what's called the TTM column. And actually Jet2 is a good example of why this is so valuable. So if you don't know what TTM means, it means the trailing 12-month figures. So we sum up all the trailing 12 months figures on things like the income statement, and we roll them into a much more timely and accurate measure. So you can see here for Jet2, I hope you can see through the gray overlay, but the trailing 12-month figures for the year are 4.3 billion in sales or revenue, whereas the year-end data was 1.2 billion. So, and you can see that this is a huge difference. It means that somebody using historic data from the last annual reports would be underestimating how much this company is making in sales and profits and so forth. So we call that TTM, and we use this trailing 12-month or last quarter approach for almost all our financial data. But it will disappear when the company releases full year earnings. So it kind of, you will see your question is, why is that sometimes there, sometimes not? If you're in America, there'll be quarterly data. So you'll see TTM data through the year because they have 4-quarter reports. And in the UK, we just have semi-annual reports for most companies, although the big caps do quarters too. And so that will come up sort of for half the year. So hopefully that's helpful to understand. Also, 2 years of forecast data. We have consensus revenue forecast, profit forecast, dividend forecast. And these are consensus figures aggregated by IBES, which is the gold standard in institutional forecasting. And they aggregate from all the brokers on the street and in the city. And they do a very, very good job, although it's a very hard job. So beware of that. There are many investors who look at the real smaller micro caps who actually do a much better job of actually finding the scuttlebutt. And you can often, the data does update as soon as Refinitiv get the data, but it's, sometimes there can be a lag on some of the micro caps. So you really can get an edge there if you're doing your own research. We also have a little growth rate column here, which shows you the kind of compound annual growth rate over the 6 historic years where necessary. And in some of these, it will show an average. So for example, on the profitability measures, it shows an average, and that's quite valuable. Now, looking at each section, I just want to kind of zoom in a bit here and just highlight a few things here. So profitability. We talked about some of the profitability measures earlier, and I don't need to probably duplicate here. But these measures are always good to eyeball. Now, when you hover over this, you'll get a pop-up chart. And a company that has, for example, very volatile operating margins can often be an indication that it's a cyclical industry or that there's prone to sort of waves of competition. In this case, all the measures for Jet2 kind of collapsed in the pandemic. So you can see that its profitability, its return on capital and equity really, really all nosedived into the red. And it is now recovering. But it's really, really helpful seeing this history as, there are some companies that just weren't impacted by those events. And if you're a dividend investor or something like that, being able to look at the stability is so important. So before I go on to dividends, I want to talk about cash flow. Now, there is that saying, what is it? Revenue is vanity, profits are sanity, and cash is king. And, you certainly learn that running a business. But cash flow, you want to flow freely. Now, if you know your company accounts, you'll know that there are income statements, balance sheets, and cash flow statements. And we wrote up some of the cash flow metrics here, which are quite useful. So the very best investments are cash cows. And the question is, how do you identify them? And one of the things I like looking, one of the reasons we designed it like this is that above this, you've got earnings per share, and you can compare that against these cash flow per share measures. And you can see, is the company converting its earnings, which it's reporting as profits, into real cash flow? Because companies can fiddle the books. They can actually report profits, but not have any cash flow. And that is a weird thing, but if you book sales now for services you're actually going to provide in the future, actually you might get high cash flow, or you might. Sorry, I should have said it the other way around. If you actually, in a sales organization, they can book a sale as revenue now, it shows up in the profit figures, but actually they've given the customers discounts and extended payment periods, and the cash flow might fall in the future. Recipe for disaster. Many companies have blown up like that. So it's always nice to compare the earnings per share against the cash flow figures. Now, we've designed this so that you've got operating cash flow, which is the cash flow from operations, from which is often offset CapEx, capital expenditure, in a resource intensive business. So, if you've kind of got hard assets that need to be invested in, or they're rolling out stores everywhere, you might see CapEx investments. And then that will then be subtracted from operating cash flow to give you free cash flow per share. It's the lifeblood of any business. It's used for, paying down debt, paying dividends, buying back shares, all the good things that shareholders like. And Warren Buffett loves free cash flow because he can do what he wants. Cash flow is hard to fudge. So it's really good to kind of give that an eyeball. Now, it doesn't mean, it really does depend on your style of investing. If you are a kind of a quality investor, and you want high free cash flow businesses, and you want dividend paying investments, this kind of area is really, really important. Next up is dividends. So I will be choosing a dividend stock later to analyze, but this allows you to assess the dividend history. So you've got dividend per share, which is very, very important. And it's really good to look at consistently growing dividends. And you don't want to see evidence of cuts if you're a dividend investor. And as you can see for Jet2, it was growing its dividend 5, 7.5, 10, and then it cut, and it's gradually started clawing it back. So, okay, you could go one-time event, pandemic, but maybe we all see the travel industry as a bit riskier now because of these sorts of events. But that is evidence of a dividend cut, and you'll be able to eyeball that with the dividend growth, which goes into the red here. These growth figures are color-coded, and again, it's the power of design and color coding on this kind of thing. It's really, really saves time. We also show the dividend yields and the forecast yield on the right. Now, the other thing you should always check is dividend cover. Ideally, you want dividend cover above 2, because that means that the dividend payment, and if you're a dividend investor, you want that payment every year for retirement or whatever you're using the income for. The dividend cover shows you and in America, you're kind of normally more used to the payout, dividend payout as a percentage, which is kind of it's kind of the same figure, but it's sort of inverted. And you look at the dividend cover and you want to see that it's above 2. So this company had very, very high amounts of dividend cover, sort of 9 or 10 times, but then the dividends collapsed. So unfortunately, it wasn't a very good example of a company that got into sort of slight dividend issues. But the pandemic came out of nowhere. But generally, you want to sort of, if it's less than 1, it can risk a cut in normal trading environments, because that means they don't have enough profits to pay the dividend, and they'll have to eat into cash, or they'll have to do other things, or raise debt to pay the dividend, which is pretty negative. And there are other red flags. I like to look at the F-score and things like that to also look for dividend quality. Now, one other line item here. I'm not going to go into all these balance sheet items. Net debt's always good to look at, by the way. I always like doing that. Average shares. Okay. Beware excessive share dilution. I cannot bang the table enough on this. This is the bane of all private investors' lives. It is something that is very little understood. And if I hope I can wake you up one time in this webinar, it's this. It is to beware share dilution. If you see the average shares growing really rapidly over time, that means the company's issuing shares to invest in R&D. It just is using the markets to raise more and more capital. That is bad for you as an investor. It means your stake is getting smaller. it means you're being diluted. It means that you have a much lower proportion of the company and the expected, what you thought in that kind of great investment for the future. You won't get as much as you thought. And it's a really important thing. It's the biggest thief of individual investor returns out there. And I can't stress this enough. The company is not self-funding if they're doing that, and they're having to raise capital for investors. They will do it again, and they will further dilute your shareholding. Now, don't get me wrong. There are growth companies that need to do it, and this is what the capital markets are for. But it is, in my opinion, it's abused on AIM a lot, and private investors get a really raw deal. The best investments have very, very, very slowly increasing average shares if they're, for example, issuing shares to do some staff compensation, or better, the number of shares is reducing. And that means they're buying back shares, which is great for you as a shareholder. So that is a really, really important fact. And it's a great sign of financial strength if number of shares are reducing. Now, I haven't looked at Next in a long time, actually, but I remember Next had a great buyback policy, and the number of shares were decreasing all the time. But here you can see for Jet2, it was very, very stable. It hadn't issued any shares. And then suddenly in the pandemic, bang, it went up to 179 million, 215, 228. They had to do what's called a rights issue to get through the pandemic and to make sure that it basically didn't go bust. So sometimes those kind of events do happen. And that's where it's worth doing your own research to understand why there might have been a share issuance. So I think with Dark Group, it's a rather different scenario. And, than some of the shares I can show you later, which have massive, massive dilution. And many of the blue sky stocks that people talk about on Twitter and everything else have issues there. So smart money sentiment is my number 7. 7 and the last one, by the way, and then I'll just whiz through a few things afterwards. So this is about shareholder activity. And we added this widget more recently. And again, this goes to the information density and signal over noise. This essentially shows you what institutions are up to. And you can see there's been sellers, a few buyers of this share, Jet2, directors. This shows quite a lot of directors selling, and community, what the actual Stockopedia community are doing and what in their portfolio. So you can see the community have been buyers of Jet2, probably because it's been a big winner in the past for them. And this is quite interesting. So let's have a look. The directors here are selling. Let's have a look. That could be a flag. You click through and you go on the directors page, and we can see here that Meeson has been selling. He sold like 40 million shares worth. And I can show you. He is the CEO, and also Heapy, who's he's the chairman. I think he might have been the founder. And Heapy, who's the CEO. They've been selling shares. Now, of course, they might be doing it for, if he's divesting his shares, there can be great reasons why people do this, but it's just something that's quite interesting to know and understand. So you can do this for the major shareholders, the institutions as well. It's really valuable. As you can see here, we show the directors further down the stock report. Philip Meeson, Stephen Heapy are right there. And so it gives you, we want to get that on the directors deals page, actually, what their job title is, because that would be more helpful. And we will do that at some point. And okay, next up, what are the brokers doing? It's again part of the smart money sentiment, and this is further down the stock report. And let me zoom in on this. This shows you the analyst consensus, okay? And it shows it to you in a black arrow, and this will say strong buy. First thing I would say is beware the consensus of analysts. It has very, very little predictive value, okay? What it has predictive value in analysts' numbers is the trend, where they're going, okay? So in this case, you've got a black arrow at strong buy and a little gray arrow slightly to the left. And that means, and I think there's a hover on those, which explains it, but it means that the broker recommendation is slightly ratcheted down recently in the last few months. But, and one key point, we did a study once on this. We did, I think, a 3 or 5 years, 3-year study of broker buy recommendations and how they performed. And this is a number of years ago now. But the buy recommendations, actually, strong buys had significantly underperformed, outperforms, and sells as well. So brokers, no matter what they say, are often incentivized to put out buy recommendations for a number of reasons in the city. So you do want to take that with a pinch of salt. Although, so I would always be more interested. Sorry, I should have said you can see here for Jet2, the black arrow is to the right of the gray arrow, which means the recommendation is going up. I'm sorry if I'm contradicting myself, but that's the way it's going. And also you can see that there's been a little upgrade here. Over the last year, the earnings per share have been falling. And I use this to understand the direction and trend of earnings forecasts. You know, I was talking about the momentum rank. The momentum rank, these are big key factors in the momentum rank. So if someone's wondering why the momentum rank is high, even if the share price is falling, have a look down here and you probably will see that the broker figures are ratcheting up. We use the last 1 to 3 months for earnings upgrades and also for recommendation changes. So that would have given Dark Group a bit of a boost. So I call that the trend in consensus. It's very valuable. And there's been tons of academic research on this. There was a study on European stocks that found that the 20% with highest upward revisions were outperformed the lowest revisions by like 16% a year. So I always look at this chart, and I try and never buy shares that are actually declining earnings forecasts. Now, okay, I've got through my 7 quick things that and it's been almost an hour on that. Now I just got a few little things I'll just quickly share before I do 3 live analyses. Some of the lesser known features on the stock reports. Okay, historic stock reports. If you go on the stock report and you click this print button, you can track back in time. So I can go right back to, like, let's go and look at it. You know, it would have been Dark Group back then. And hopefully this will come up. Yeah, Dark Group. Okay, yeah, 2014, it had a 99 rank. We had slightly different design, lots of the similar things you can see on the page. And that was before, and it was, you know, £2 then, and it sort of more than multi-bag from there. So that's really valuable, and you can sort of go back in time and look at sort of some of the data, which I think is a really good feature to know about, and it's really helpful. So next up, the red flag pop-up checklist. Yeah. Oh, before I do that, everything's clickable. So if you don't know what something is, just click it. You'll get a pop-up. It explains what it does. Quite helpful. We put quite a lot of effort into that. Really educational page, the stock report. Now, if you look here, and I hope you can see this, on these red flags, if I was to click on it, you can see I get the breakdown of the Piotrowski F-score. So this one is actually showing you in plain English all the tests that are done to come up with that score. Now, that's really great. You know, I can see that, why is it not going to 9? It's not increasing its ability to pay short-term debts. You get the help text, the definition, and so on and so forth. So it's really valuable. And we do the same thing for the cooking the book score or the earnings manipulation score, and also for the Z score. So quite valuable. And you can sort of have a little look into the risk factors that might be bringing it down. So that's something that, you know, often people don't know about, and I think it's really cool. Stock rank deltas. So these little arrows here, I'm sure you probably have hovered over them, but they show the direction of change in the last 30 days of that rank. So for Jet2, it's been going up. So unsurprisingly, since the beginning of the year, it's gone up. The value rank's gone down, and so that's reduced, but the momentum rank's gone up. And the momentum rank's gone up because the price is rising, and the earnings, we can see that the brokers are upping their numbers on the basis of recent trading statements and so forth. So that's a really good thing to know. One thing, if you're a UK investor, this is really valuable. Scroll down, and you can, I'd love to have that up in the top actually, but you can actually see what exchange this is on. So we actually show that if it's on the AIM market or the main market, and that's quite valuable. So you can see here that it's on AIM, which means that it benefits from better tax regime for stamp duty. For AIM stocks don't have stamp duty, and they have inheritance tax benefits too. So that's quite valuable to know for investors. I think you might be able to get that in here as well. No, it's not. It's actually only down there. So that's just one thing to know. And okay, yeah. So just one thing on director profiles. So each of these is a link. So if you want to, you can go and click and find out more about that director. You know, we've linked here with a Google search, and you can see. Well, there's Travel Weekly, Jet2 chairman, nets 42 million in share sales. So you can go and find out more about them. Often there's a LinkedIn, and there's more profile information on those directors. It's quite good research, that. And then finally, down here at the bottom, we kind of go similar to Jet2. So there's a few shares here. Now, we do our best on this to try and sort of create a comparison from all the sectors and so on. But we can see Wizz Air here, EasyJet, I know is an airline. That's a large cap airline. If you compare them, click it, with any luck, it will go through to the comparison page, which is quite a nifty way. And, you can see here against these airlines, we stack them up for a lot of those stock report ratios on the left. Very, very similar set of ratios to what we publish on the stock reports. And we just basically go, okay, how many it wins? And this one's winning 17 out of 40 of the 40 tests, which means it just nudges out IAG. And it doesn't mean it's a buy, nothing like that, but it's quite a nice way of comparing stocks, and you can search for whatever, shares you like. So that's quite a nifty little trick to know. So I next said I would do analyzing 3 stocks, analyzing a growth share, a value share, and an income share. So this is going to be the last thing I do before I start answering some questions. So hopefully it'll only be about 10 minutes on this. Okay, I wanted to basically just sort of show you a growth stock checklist. There's lots of different approaches to growth stocks. You can look at all our guru screens for lots of different ways. Everyone has their own way. But this is what I would call a growth at a reasonable price kind of strategy or checklist, I would say. The style advocates of that are people like Jim Slater in his, classic Zulu principle from like the 90s, or Peter Lynch in One Up on Wall Street and other kind of luminaries like that. So in a real rough and ready way, okay, there's more depth, way more depth in the books. You might, well, actually, Slater would look for a P less than 20, but let's say you're kind of a bit more willing to go for growth, which might be at a higher valuation. I personally don't like high valuations in this environment because rates are going up and they've been going up. Earnings growth rate greater than the P ratio is a good rule of thumb. That's defined by the PEG. Now, the PEG is at the top right of the stock reports, and that's the price earnings divided by the growth rate. The great way to think about that is when the PEG is less than 1, the growth rate is higher than the P ratio. And that means you're basically getting lots of growth for the value. And a good profitability, I always like to look for a return on capital greater than 12% is a nice thing to have. Not too much debt. So Jim Slater liked to look for the gearing ratio or debt to equity like lower than 50%, and beating the market. Okay, relative strength above 0, like above the index. So these are just some ideas. Again, we'll do a survey to see if you want to go into more detail on these kind of things, because I know my dad tells me I go far too fast and I get too excited. It's too much to cover. How can I stop? Now I'm going to look at TriFast from this perspective, thanks to Megan, who has been finding me some shares that qualify for these things. So let's have a quick look at TriFast. Okay, I'll just search it up. And by the way, I don't know these shares necessarily myself in much depth. TriFast is a UK company engaged in industrial fastenings and components and all that kind of stuff. They've got lots of kind of customers, and there it is. It's on the main market, so it's actually on the main market instead of on AIM. Okay, it's got a low rank. It's got a very average ranking. Okay, but we're looking at this from a growth perspective. The rank is not the be all and end all in the world. Adventurous small cap. It's kind of neutral style because all the ranks are a bit kind of in the middle, like I said. So it doesn't have that. But we know it's an adventurous small cap, 100 million market cap, enterprise value. Okay, it's got about 60 million. I can instantly see comparing that with that. It's got some debt, but nothing kind of too heavy, but still 60 million in debt to consider. Now, if I'm a growth investor, the first thing I do is I look at, I'm just going to zoom in a bit so you can see. Okay, hopefully you can see that okay. The P ratio here, I want that to be lower than the growth rate, okay? Now, that's a P ratio of 8.4. So this is actually a very cheap stock. It's very cheap against the industry in the market. The growth rate projected and forecast is really high, like 20% growth projected. Maybe it's had a wobble and it's recovering. I'm not sure. The yield, it's got a yield. So, anyway, it looks like this might be a good GARP play, growth at a reasonable price. But we have to sort of find out, is it recovering? And I haven't had time to prep this properly. So anyway, it looks like there's sort of some good activity in the community and directors upping their stakes. I might be getting those from, by the way, they might be getting them from, options and stuff. So you have to be wary of that. Now, so generally we can see there's a nice picture there, but the quality, okay, that's not passing my quality checklist really very much. Return on capital is very low. Okay. I don't like that. That's not cool. And it's low margins. So the first thing I do, I jump down to this section, the profitability section here, where I've got the same measures. And this tells a story, right? The margins used to be at 9%, 8%. Maybe there's been a pandemic issue here. I don't know. But the margins are quite low. And why are they still quite low? That needs investigating. Return on capital used to be quite a high profitability company, but now they're really low. Why? That's where you'd want to go and do your kind of fundamental research, right? And it does look like Now, we don't do forecasts on those, but it does look like the profitability is recovering. So it used to be doing 12 million in profit a year, and it looks like it's forecast to do 13 million. So, you know, in the chart on the right, you can see it's getting back. So that may be a leading indicator. The profitability is going to improve. That means the return on capital is coming back. Maybe because you're kind of a scuttlebutt investor, you see a chance to get in on this before the ranks actually change. Because if it all improves, the quality rank will go up and the momentum rank will go up. The market might wake up. I'm not saying, look, this is just my cursory glance, but as I look at this. Okay, so gearing, okay, I prefer lower than 50%, but 58% is absolutely fine. And the net gearing is lower. That means they've got some cash. Cash on the balance sheet is there. And, you know, so it's all very nice and manageable. Let's have a look at average shares. There's only been 2% dilution a year. That's perfectly comfortable. You should be very comfortable with that as an investor. And they've got like good interest cover here. They've got, you know, so there's a picture building here that this might be a share that institutions haven't woken up to, that perhaps, well, the brokers certainly think it's in recovery. Will that recovery come through? And one thing that came on my radar here is clicking through to look at the institutions. I spotted that Slater Investments, which is the, I mentioned Jim Slater too much, but Slater Investments is a fantastic fund manager. They own 12%, and they have up their stake in February by 1.2 million shares and 3.5 million shares in their growth fund. So that is a kind of, you know, quite a vote of confidence there by Mark Slater, the fund manager. So yeah, just a very, very interesting one. So let's go on to my next one, a value stock checklist. Value and momentum is one of my preferred routes. And by the way, I don't own that share. I don't own the shares I'm talking about today. And so value momentum is a turnaround strategy, trying to buy cheap stocks on the turn with momentum. And the style advocates, so Jim O'Shaughnessy talks about it in What Works on Wall Street, Charles Kirkpatrick, there's a whole range of people, and a lot of quants love value and momentum. It's kind of it ignores quality. That's the thing you got to be aware of. If you're someone who wants to buy really safe, good blue chip companies, turn away now. This is not for you. This is about, you know, people that take on a bit more risk. So price to sales ratio, often, look, there's lots of ways of skinning a cat for value and momentum. But as an example, regularly, because turnaround situations don't have earnings, you know, they might, you know, maybe earnings have disappeared. So you use the price to sales ratio because profits or earnings, obviously sales is kind of like, you know, don't go away as quickly as earnings. So in a recession, you're going to lose your profits, but you're going to keep most of your sales. So you want to try and find stocks that are cheap versus the sales if the earnings are a bit unreliable. Okay. So also you really want to see strong relative strength in the last 6 months or 1 year as these stocks are turning around. And ideally you might see earnings momentum. So brokers upping their forecasts, hopefully not too much debt, and profitability improving. Okay. So you often get in these kind of turnaround situations, operational gearing, which sort of drives up the numbers. So let's have a look at one. And often these are small caps. Let's have a look at one, Card Factory. So let's jump onto, oops, where did I go? What have I done? Just got to go and zip through this again. Card Factory, here we go. So I'm going to look at Card Factory in the UK because it's been getting a little bit of buzz on the discussion areas. And you can see here, this is a share instantly. Okay, well, it's got a high rank. That's one thing. It looks like it's got quality value and momentum. It looks like market cap to enterprise value. It's definitely got debt, highly speculative. Okay, always look at the classifications. Cyclical, speculative, worried. You know, it means also cyclicals do really well on upturns, and especially if they're highly speculative. But you know, if you know, recession comes and we get an extended bear market, it might, you know, or other retail high street nightmares, you know, that could suffer. And so anyway, you can see here on a kind of, let's look at this. The rank got quite high then, but it didn't kind of work out for it. And then it popped up again, and it's now gone up to the kind of 99 zone, and it's sort of zooming up. All the relative strength measures here are quite high on a 6 month, 1 year view. So, you know, over 6 months, this share is actually kind of really, really, it's like, you know, it's doubled actually. And the P ratio is forecast to be 9.5. Okay, there's no earnings growth. You know, it's a turnaround situation. The brokers don't seem to be forecasting any growth. But because the price to sales ratio, less than 1, as I said, you know, this is a very cheap against its sales as a whole. And actually return on capital is pretty good. There is a bit of a, as I said, there's debt here. Bankruptcy risk sort of flag is in the cautious zone, worth kind of investigating. Oh, look, liquidity. Current ratio and quick ratio, they show that there might be shorter term liquidity issues, but sometimes in retailers that can be normal. So, this is just me again. I haven't checked the accounts or anything. Revenues going up. Obviously looks like COVID hit it badly. Net profits are recovering. They're still very low. So maybe there's kind of, potential for those to come right back. Now let's look at, and let's have a look at the stability of the margins. They've definitely declined over time. And that, is worth looking into. But it used to be a very high return on capital company, and its return on capital is going up. No dividends. Well, cut the dividends, might be coming back. Not really of interest there. It seemed like they got lots of cash in 2022. Not sure why. Weighted. There's been zero dilution. I think they managed to get through the whole pandemic without issuing any shares. Maybe they issued debt. I'm not sure. I don't know the story. But one thing to be aware of, if you click on discussions, you're going to get all the small cap reports. And Paul and Graham, you can see they've done lots of reports on Card Factory, card. And if you click through, you can quickly go search for whatever they've said. We've been increasingly impressed with it, trading updates. I do not own it, but the small cap report is so good in these sorts of situations, and they do an absolutely incredible job in the community there. I know lots of you are probably from the community there. It's just incredible. I'm just so in awe. Anyway, not a holder. Last one. Okay, let's go back. Let's do an income stock. Great for retirees seeking solid income growth. Okay, and remember, these shares are not recommendations. It's just an example of how I'd read the stock reports. Style Advocate, SocGen did a classic paper on quality income way back. Jamie, who's a subscriber at compoundincome.org, do check it out. He's got his own subscription thing going on there, but he's brilliant at this stuff. And I'm not saying this is his checklist. This is sort of my rough and ready checklist. Let's say you've got a solid yield. Rates have gone up. You want, yields are competing against savings. So, you kind of want them to be quite high if you're in dividend stocks. I would always look for kind of more cheaper shares with higher yields myself in income stocks, but because I just like the safety of decent value, lower valuation. High dividend cover, like I said, you want the dividends to be covered by profits. Don't want dividend cuts. Good return on capital, so good profitability, because that ensures you've got the engine to keep paying dividends and hopefully grow. I would also say low volatility, lower, much more conservative risk ratings are really helpful for income stocks. And mid and large caps, small caps for a quality income, they can be more unreliable. So, that is something to be aware of. IG, let's have a look at it. Let's go have a look at IG, next on my list. So IG Group is a UK-based spread better. I have an account with them myself. Love IG. It's fantastic. It's spread betting is a way that many investors sort of invest in markets, but they do. There's a lot of leverage there, and a lot of people blow up. In fact, a lot of the business model on spread betting companies is for them to blow up. They're a bit like, if you're in America, they're kind of more like a geared investment, more like options over there. We don't really have an options market here. Now, look, let's have a quick look. Financials, balanced large cap super stock. So that balanced means that it's lower volatility, okay? It's about in the 25% least volatile of the market, which looks surprising if you look at the chart, but that's what it is. Large cap super stock, high rank, very high quality rank, and quite cheap, momentum a bit kind of more normal, okay? So again, P ratio, very, very low. We've got this 5.84% projected yield, and and then we can see actually here, Benjamin Graham defensive investor screen, a Buffett screen it qualifies for. Free cash flow cows, you want that for dividend stocks. Large cap dividend attraction, it's got 6 screens going for it. Really high returns on capital and high margins. And it's an amazing truck of a business, this. And I mean, its revenue's just grown and grown, and profits gone up. It looks like it had a little wobble in 2019. And there have been regulatory changes. One of the reasons that stocks like this and spread betting get kind of lower ratings, because it's always that regulatory question mark over, will the tax regime change? Will the regulator sort of be more difficult with them? And they're much less able to do advertising, that kind of thing. But look, no debt. You've got market cap above the enterprise value, and that means they've got net cash. They've got loads and loads of cash. Net debt's negative. Dividend per share, they've never cut it. They never cut it. They stalled it for a while, but it seems to be back to growth. And the cover, yeah, it's only 2 times. It could be more comfortable, but pretty well covered. And, things like, look at the free cash flow per share here. They're converting almost all operating cash flow through to free cash flow, but they do make some investments in and so on and so forth. So, a very, very interesting picture there. You've got broker upgrades going up in this share as well. Sort of there's earnings momentum, which is coming through too. So there's kind of lots and lots of good stuff here. And, I can go and compare it against, let's say, CMC, which I know is a kind of spread better. Let's just have a look at just against CMC and how that compares. And IG's winning. So, on a bunch of those metrics. So anyway, that's kind of, I've gone to, I knew this would be extensive webinar because so much to cover and I feel like I've really rushed, but I will look at a bit of Q&A now. So thank you if you've been flagging a lot of stuff here. So I'm going to start, and this, feel free, if you don't listen to the Q&A, but there'll be some good stuff here. So you might learn a lot, and I'll try and think carefully about which questions to ask. And okay, one question that comes up regularly is, because of the accounting standards changes, operating leases are now, due to the accounting standards changes, are rolled into, probably best to go on the site and sort of look at something like JD Sport, I guess, which is a bit of an issue for a lot of retailers because it sort of shows that they have often they have more gearing than one might expect. Now, I don't know if JD, I haven't prepped this, so I'll just go into the balance sheet, but often we do show, current portion of capital leases. So you can think of like when companies are doing retail, they have shops and they kind of rent them. And often that used to go out like as a rental expense, but actually they'll lease it. So often they'll lease these, and the regulatory changes made them kind of roll this into the debt figures. So I'm not sure whether this happened for this company in particular, but there certainly was a spike in debt in that year when it went up to sort of 338. But there's lots of retailers and who are affected by this, and we've often had requests that if we could factor it out of the gearing ratios like we do with intangibles and pensions. And so that is certainly something that we've got our eye on and we may well do in future. So that's just not asking the question there. How to check the size of debt in an inflationary period? Yeah, I mean, hopefully I've answered that on the site. There's lots of ways: checking the gearing, looking at net debt, going actually into the accounts. High geared companies they've got to refinance their debt, and they'll have to refinance at higher interest rates. So when you see that interest cover is quite low on a share, that can be a cause for concern. I mean, Paul is especially good on balance sheets in the small cap report. And you can learn so much by following him. He's absolutely brilliant on this. And, anyways. And so let me have a little look. How to protect capital and secure good income. Hopefully I've kind of answered some of that in my demonstration. Should you diversify internationally? So everyone has a home bias in their investments. One thing we would like to add to the reports in future is the geographic segmentation of sales, because a lot of companies earn a lot of their money overseas. And so you actually can get quite good international diversification in just UK shares. If you're in the UK, or like US shares in America, if you have more international exposure through the companies you own. Now, often large caps earn a lot internationally. So I know there's some hoo-ha about the big oil companies, BP and so forth, shielding their profits from the tax man because they actually earn a lot of it abroad and stuff. So I it's something to sort of look into. So digging in, that's where you can really do your own research. It's like digging into all the accounts and finding out where they do all that. But we hope we can get the data in future. So I'm just going to start at the bottom and I'm going to see if I can have a little look. Notes tab. Yes, I guess one thing. The notes tab's useful. Yeah, I know. Like we do have this little notes thing, and I'd love to. Oh, you see, that's me saying I'm testing that out. I'd love to add more functionality in here and have a real journaling feature, and maybe that is something we could do in future. And if we could actually add PDFs, it would be great. But remember, you can set alerts on all our fundamental data. Somebody said you don't do stop losses, but we do actually. We do trailing stops here and fundamental alerts based on the stock ranks. So, you can get alerts on your stocks there as well. That's something I didn't cover. And yeah, no, great ideas, Charles, on the notes tab. And Is it possible to overlay EPS on a chart? Not yet. That's something we're going to be working on. And I'm not going to commit to it on when, but I would love that myself. Why are some stock rankings volatile? I mean, often some shares can have volatile stock ranks because they just have, they update. Actually, it's a good question to answer is that somebody asked is what changes the ranks? Okay, so normally the factors that change the rankings are the quality rank will only change based on companies reporting results on an interim, quarterly, or annual basis. But it will drift gradually because the ranks of all the companies around it are changing. But you'll see the big jumps on statements. So suddenly you can see a big jump based on when company accounts come out. Now, the value rank will be based on statements as well as the price, because it's price against the P ratio, the price to book ratio. They're often based on accounting measures. So if the price rallies, like you see here for JD, the value rank's gone down because the price has rocketed and the momentum rank goes up. So they kind of act as a counterweight to each other, the momentum and value ranks. But momentum rank changes on price changes as well as on earnings forecast changes or on results. So those are really kind of the big things: broker forecast changes and financial statements that are released and price changes. Those are the kind of main factors. And so some stocks are more volatile because sometimes you see more volatile share price, more volatile earnings, more volatile broker forecasts. No, so yeah, Lee, the momentum score would be different to IBD's momentum score because it's got different factors in it. We are thinking about breaking down the momentum rank into a price momentum rank and earnings momentum rank that you can actually use independently. So watch this space. It might be some time. Okay, going forward. Sorry if I miss any. If someone said to me that the stock rank is a lagging indicator, what would you say? I would say two aspects here. Firstly, it's kind of been shown that forecast data can be unreliable, which is why we only use a trend in forecasts. So the trends are predictive of future. Trends tend to persist. And what you find is that trends in estimates, trends in prices often predict the future movements of share prices and valuations. And that's why momentum, even Farmer and French, Nobel Prize winning Farmer and French, declared that momentum is the king of the factors. And so I would say yes, the quality rank and the value rank, they use backward-looking statements items in their composition, but the momentum rank is a more forward-looking measure. And also it's been found many, many times that actually historic data for valuation ratios is more powerful as a predictor than forecast versions of them. So that is something worth remembering. So, Jet 2. Yeah, so sorry, I'm just going to jump onto Jet 2 because someone's asked what caused it to jump. Something we'd like to, I believe that was results that were released then. So probably a big change in, well, you can see here the trailing 12-month data here, which was probably released around that time. You had this sudden massive jump in profitability, in revenue, and so on and so forth. So the whole company jumped from losses into profits, and that made it go bang. And so suddenly it went from a 40 rank to a 90 plus rank, and that's kind of what can happen. Let's see some others. So let me have a look. There's lots of questions on the ranks, and I'm going to sort of look at some other ones. So I'm going to try and sort of skip over some of the ranks ones because we'll do a webinar on that at some point. On StockReports, there's a lot of questions about the ranks. And at what level do I become concerned about the F score and the bankruptcy risk? So I don't like buying shares with a really weak health trend. As I said, I'm kind of increasingly more of a quality and momentum and value and momentum investor. And therefore, I like seeing fundamentals moving in the right direction, which is more at this end. If a company's got a low F score, it means that basically most of these factors are deteriorating. And I could screen for a few and I could find them live, but a lot of these measures are based on the difference between last year and this year's numbers. And I don't want to be owning companies that have debt increasing, that a worse ability to pay debts, that's raising funds to cover the problems, that's reducing pricing power, etc. So I don't like seeing things in 1 to 3 or 4. I prefer seeing things up 6, 7, 8, 9 in the health trend. The Z score, I'm more amenable to, as I said, because I'm more of a, got more of a turnaround bias. So I don't actually mind, and I cover this in the ebook I'll be publishing soon. But as an example was Wincanton Group, which actually is a nice one to look at. It's probably still got, I haven't looked at this in a while, but it's probably still got a sort of not far from the distress zone bankruptcy risk. Yeah, it's classic for Wincanton. And Wincanton, okay, it's got about a 73 rank, not super high quality. But actually, when we first launched the ranks, I remember the shock and horror from the community that we had this company with kind of quite a lot of balance sheet issues. And we gave it a 99 at the time, and it kind of tripled or something over time, and it did so well in spite of that issue. And that's kind of the nature of sort of value and momentum. It got really cheap, and then the momentum sort of carried it. Now, it doesn't, in every circumstance, that's not a parallel. I'm not saying ignore it, but it does require, it's kind of a flag for more research. So I would say if it's in the distress zone, it doesn't necessarily mean, because these are all statistical measures, right? There'll be a cohort, it'll be in a cohort of stocks which has some form of financial stress. And that means they might need to raise capital, they might need to raise, pay off debt, whatever it is. But it's something worth looking into. Maybe they can trade their way out of it and get more efficient as a business. So it's just something to kind of be conscious of. And similarly for the manipulation risk, just, if that is flagged, just go have a look, dig into some of the kind of factors that might be, which you can actually kind of look at here and try and understand them. And they come up in a checklist, but that's quite useful. What's my favorite screen? I love the ranks so much now that I kind of, much more of a sort of value momentum and quality momentum screener. But my favorite screens are Slater Zulu and Can Slim. I from a Can Slim, from a QM and more of a trading perspective, I just love that screen. It's really it's got such great results across Europe as well. It's kind of incredible. We do occasionally have like an issue. Let me just have a little look here. Look at the Bill O'Neill screen. So there's only 3 stocks that qualify for this, and this is actually, they're all 4 stocks. Sorry, very high. They're actually very high stock ranks. Very unusual. SureServe, Foresight, plus 500, and Glencore. Glencore's massive. It's just kind of crazy that it's got qualifying for this screen. One of the things actually with if you do have an international subscription, you can find so many more. Like it's kind of really cool, and often the performance has outperformed the UK, and this is across all of Europe, and you can find some extraordinary companies doing this. It blows you away sometimes, and I when I'm feeling like there's lean pickings on the screens because of the UK, some of these screens are quite restrictive criteria. Broadening the horizon is quite a good thing to do. Let me have a look. I'm trying to sort of have a look here. On the stock reports. So there's a fair bit about ranks. I'm conscious of time. A few things on different features. I'm going to try and keep this. Yeah, share dilution. Well done, Lawrence. Yeah, it's not factored into the value rank. So we're not actually factoring dilution in. It is actually something which we could consider for in future for quality. But actually it'd be worth me kind of showing, I don't know. Let's have a look at, for example, Avacta. I know a lot of investors own Avacta, and probably quite a lot of people on the call may well own Avacta. And Avacta, as you probably know, is kind of quite a big pandemic winner. And they're, the hype about it is that they've kind of, they've got a technology that kind of cures cancer. Basically it's like this thing that delivers, I'm going to, show my ignorance now, but in essence, it kind of, in tests, apparently, according to the company, it delivers the chemo much more effectively to targeted cells, and it massively reduces things like hair loss and things like that. So could be an incredible thing, and for anybody who's suffered from cancer. And I lost my mum to breast cancer, etc. So you can see it's gone quite well in the last month. It's really been ticking up. There is quite a lot of hype on this highly speculative mid-cap momentum trap. Again, that basically means you've got high momentum but very expensive. literally, you can't value it on traditional metrics. It's all jam tomorrow. Quality super low in terms of all the things that we look at. So, you kind of get these kind of, horror show financials, but you look at a company like this and you see this massive dilution. And I think that's something everyone's got to bear in mind. Bringing a technology like this to the public, it's going to take a lot of capital. So the company have to get bought out or have to invest hugely, I presume. And I don't know, I haven't done the research on it myself, but I would presume there'll be more dilution to come. Now they've got 17 million in cash. They raised 50 million in 2020. And, you presume that that's burning down at quite a high rate, as you can see, and that they'll have to do a fundraising. So we will see the average shares spike again in this, which will reduce your stake. And I remember Sirius Minerals, was it Sirius Minerals up in the north of England? I mean, it just had the most horrific dilution. And this happens again and again and again in these sort of, in well-hyped shares. And it's just something to beware of because, it means that your slice of the future business will be smaller. And often it can mean you just don't get any return at all. But I'm not saying that happened with Avacta. I mean, I'm not a holder. My brother is, and he's a big believer in it. And, he thinks, okay, this could be a 20 bagger. So, there's always a corner of people's portfolio for that. And can we explain the graph and analyst recommendations? Yes, I can do that again. I will do this again. So this chart shows you, sorry, just get rid of that. The forecast of earnings per share for 2022 and 2023. So I'm presuming that this company, Avacta, hasn't released results yet for the year end. We're only in February, right? So back in August 2021, the broker was forecasting minus 8.5p for this December's results, for December 22's results. And over time, it's sort of gradually increased. So they're forecasting slightly less. And for 2023, this light blue line is the numbers forecast for 2023. So like we're going to go and look at something, I don't know, let's have a look at Card Factory again. And jump down here. So Card Factory, okay, there was a cut last, it did cut forecast. It's not a good example. I think IG was the one that had it trending up. So let's have a look at IG's forecast because they had a sort of more of an uptrend here. Right. So the forecast for 2023's profit per share, earnings per share, back in August in 2021, 18 months ago, was only 80p. That's ticked up to them predicting 93p now for the results that are going to be announced in 31st of May this year. So you can see that shows you there's been earnings upgrades going through time. And this looks at both this year's and next year's kind of forecast. So hopefully that answers the question. I like seeing a nice up and to the right chart on that. It's always a nice thing to see because you want the brokers to be kind of underestimating and ratcheting up their forecasts over time. Yes. Market cap versus enterprise value. Yeah, I'll give you this. I'll explain this again. Market cap is the value of the shares or equity that the company has issued. So you just literally, you multiply the number of shares, which is down here. Where is it? Number of shares. Sorry, shares in issue, 415 million, times the share price, and you get the market cap. Often though, if there's a B list or a dual list somewhere else in the world, they get factored in too. But generally, if it's got one listing, that's how that's done. Enterprise value, it adds, I mean, there's a few minority interest and preference shares which come into this too. But in essence, it adds the net debt. So in this instance, and if the enterprise value is higher than the market cap, it means the value of the enterprise is the equity plus the debt. So that's why you add the market cap of the equity to the debt value to create the value of the enterprise. Okay, that's the capital that it sort of has. Now you can see here, this one has got enterprise value less than the market cap. That means it's got net cash. And so you can see $1 billion on the balance sheet in cash for IG. And the net debt is minus 689, which often correlates with the gap here. Now, there are one or two different factors that come in, but you can read about it. There are some quirks on sort of strangely structured companies which come into it. That's a little bit more detail there. Will I do a webinar on charting? I have done one before, actually. I probably will do again. And Kenneth, the pandemic did mean that many companies cut dividends. I think you've got to just kind of use your judgment on that. I mean, some sectors can be seen as higher risk now because, that the world now has a playbook for dealing with these pandemics. And okay, I'm hoping there's not another one in my lifetime, but I think we all realize there's a much higher risk of these things happening than we used to know, than we used to. So you've got to use your judgment on that. But yeah, if you think it's a stable business and it was a one-time event, then you can trust that as you wish. But quality income, finding those safe dividends and those dividend aristocrats that just never cut the dividend. I mean, that they are gold. The directors' dealings bar. So I mean, one thing on the directors' bar here, and it's something we're actually discussing internally, is that sometimes basically this shows the change in ownership of the directors. So actually, it does factor in. It's not just open market trading. So if I go through, well, actually, you can see IG, there actually has been quite a lot of director buying. But often if you see exercise of share options or warrants, or they have some sort of gift or something in the structure, you can often see some sells here. And you're thinking, well, we should be showing the sells. But proportionally, it can sometimes be that the director ownership has increased. Now, so we're kind of having some discussion. Should we just do open market trading or actually show the actual overall ownership change? So that's something to consider there. Target share prices. Target share prices. I mean, look, this comes up every now and then. The price target is quite an annoying thing. We will improve it, but the price target here, as you can see on this stock, is quite significantly, this is the broker target, above the share price. In some companies that report, for example, in dollars. So for example, I think BP, I know Vodafone reports in euros. I think BP might report in dollars, and because they got their ADR. And if you look down here, so that price target is showing it in dollars because we get the estimates in dollars. So that's just a nuanced thing. We do factor that in a different way, but that's something we do need to improve that. So there's always things to improve, right? I'm not saying we've got everything right. And Robin Legate, great to see you on the call, Robin. Any room for a line showing the ratio of EPS to operating cash flow per share? I would love that. We are going to chart fundamental momentum in future, but I'm not going to promise a date. And we are going to be working a lot on our archive data in at some point this year, and we're going to see what comes from that. Would we add return on invested capital on the WACC? Again, we will improve more fundamental data over time. Why not pure relative strength with the momentum factor? Good question. And I would say, we factor in, and if you want to go and look at the composition of these things, click it, and you can go. We'll go into the help section, and you can see. So in the momentum rank, we've got 52-week highs, the 200-day against the 50-day, and the 1 year and 6 month relative strength. And the reason is we did tons of research on this, and I think it was George and Huang who did the 52-week high research. And I've written this up in my ebook quite extensively, but generally you find that multi-factor approaches work better than single-factor approaches. And I think that's a key thing here, is that we wanted a multi-factor approach on price and a multi-factor approach on earnings. And that's, our momentum rank has performed extensively well, brilliantly well. So I am, very, very comfortable with the way that we are computing it. No, we can't screen for major shareholders and directors yet, but we will be doing in future. And again, there's a few questions about, can you show the trend in some of these metrics? One thing I would say is we're gonna chart fundamentals over at some point in the future. So I'm not going to commit to it on this webinar, but it's very, very high on our list. One thing I would say is, if you want to see what the F score was in the past, just go and click for a historic report. If you want to see what the momentum rank was in the past, click for a historic report. They're not as pretty as the web version, but you can see the data, and I think that's really valuable. So you can almost build your own chart if you like. And hang on a minute, Helen. Sorry. Yeah, financials is something also we want to improve. We want to actually improve and have bank and insurer unique rankings, but at the moment we don't have the ability to do that. How do we report? How do we cope with different reporting requirements in the Europe and US? Well, we rely on Refinitiv's standardized financials, which standardizes basically almost all companies on the same basis. So they have their own chart of accounts, which you can see is used here, and they have pretty much the same process for global stocks. So that is how that is handled. The standardization of financials happens at the Refinitiv end. We consume standardized financials. There are actually company-specific financials too, which you'll find in the annual reports and interim statements. But that's how we're able to do this across European, Australian, American, Asian stocks, et cetera, et cetera. So that's the kind of way that we do that. Helen, I'm trying to understand your question. The question was about the analyst recommendation versus performance on the slide. Let me just whiz back to my slides and see if I can go back a little bit back in time to the analyst. I actually wanted some clarification on some of the smart money sentiment. I've gone too far forward, gone too far back actually, and I think I've crashed it. Okay, you're gonna have to maybe I have to skip that. But let me just go actually on a stock report. So I think maybe it's about the analyst recommendation here. I think we were looking at IG, and I don't know if I have the exact question, but I'll try and answer what I think you were saying. Actually, I think it was Card Factory. Basically, we found that strong buy recommendations actually tend to underperform the rest. And that's partly, I think, because often you have very, very limited, in small caps, you might have one broker saying strong buy. And it's a much, much better measure if you look at what the change in recommendation has been over time. So it looks like actually the current and 3 months ago recommendation is the same in this stock. And I don't know whether that answers your question. I'm sorry if I don't understand it. Lee, how did the pandemic affect Stocko? We had a great boom in subscribers, and then we had a pretty rough year last year. So thanks for asking. We're pretty stable now, but it was a rough patch we hit last year. But it's we're doing some fantastic work at the moment, and everything is kind of looking up again. So hopefully everything will go on from strength to strength. But it definitely impeded our development capacity last year. And, because with bear markets, you tend to find less interest in the stock market and that kind of thing. So, but anyway, yeah, thanks for asking. Are there any plans for an API? You never know, one day. And please do send in your webinar ideas. I will have a look at that in future. Right. Well, we still got 443 of you. So yeah, knowing when to sell. I mean, Chris, it's a good thing. The tools on the charts page, it would be good to have a webinar on that. I won't do it now. Look, I'm a big believer in simplicity in charts. So I'll give you a quick overview of some thoughts I have. And if I'm I like to buy shares that are kind of above their 200-day moving average. It's simple. It goes right back to Stan Weinstein, who wrote a fantastic book. I've got it at home because I love it so much, not here. And Stan Weinstein, would use the kind of longer term moving averages, and he would kind of look at the different stages of a stock, the different bases it might go through. And another one I love is insider buy super stocks, which is companies that have significant director buying. And I mean, actually, what was it? Was it Inspecs that? I think Inspecs, which had some significant director buying at the low, and it's absolutely rocketed. And it sort of reminds me of a situation from Insider Buy's super stocks, because I'm pretty sure, I haven't looked. Yeah, there was quite a lot of director buying. I mean, this guy Totten bought 400 grand. Like, you've got real kind of unison buying in October and November. And what happen if you do find those kind of situations? So October, November, you're talking right at the lows. And if we sort of zoom in on a kind of 6 month basis, there must have been something happened here, some sort of profit warning or something. And they were all buying around here. And okay, went a bit lower, and then it sort of jumped. So you've had like 2023 year to date, it's gone from sort of, it's more than doubled. And if I just put the crosshair on here, you can sort of see what's happened. 38 up to 42. Now in Insider Buy Super Stocks, written by a guy called Jesse Stein, and I really, really love that book. He actually kind of looks at kind of weekly data, and he draws a moving average. He'll draw a sort of a 10-week moving average, and would always be looking for shares like this to come back towards their 10-week moving average, and then buy again, because often these sort of highly speculative shares, they can pull back. I remember listening to Paul's podcast. Paul Scott's podcast is really great. He was talking about Inspecs, and he said he couldn't understand why it had gone up so much because the company had just said that, you know, it basically was in line, and then it looks like it might have been chased, but you know, maybe we'll come back and provide like a, you know, another opportunity. It's a low ranked share, speculative. What can I say? So anyway, that's something I think. Sorry. Okay. Well, this is more of a subscriber question. Why have we dropped the 3 years plan? And I'll tell you why. And I know like a lot of, we had biennial and triennial plans, and there's a real, really great for people who wanted to be a loyal subscriber over time. And I'm afraid last year, one of the challenges we had was that our current payment provider didn't support the new EU regulations on payments. And we had to move our payment provider from what's called Recurly to Stripe. And Stripe now, unfortunately, with their subscription product, they don't support anything beyond a year of recurring billing. So we actually were forced to deprecate triennial and biennial billing. And luckily, we solved the kind of the payments issue. But that's one of the reasons why there weren't so many features on the site last year, is because we had to do all this kind of operational stuff that just comes with running a business, and it was frustrating for everybody. But we got it done, and so I'm sorry about that, but that's just something that we had to do. And I'm, you know, I really appreciate your loyalty to the biz, and thanks for still being a subscriber. Okay, and let's have a little look if there are any others. Stan Weinstein says 30-week MA. Yeah, so 150 days exactly. Anyway, and also look at the Wyckoff method. Right, listen, I'm sorry if I missed any questions. There have been so many good ones. We still got 400 on the webinar. Thanks so much, guys. Really appreciate it. Maybe we'll be able to do something with all this and chop it up and present it in different ways. And thanks so much for spending you must be so hungry. It's almost 8 o'clock. I'm starving. Thanks and good night, and wishing you all the best for the future. And thanks for really, StockReports is all because of you guys. You know, we wouldn't be able to do it if you weren't, you know, we were in business with you, you know. So thank you so much for your loyalty, for being a subscriber. It really means a lot to us. And you really, you know, you help fund our development and our team and all the good work we do. And all we're going to do is get better. So, you know, thank you. And wishing you all the best.